Have you ever wondered why 90% of people who enter the stock market end up losing money, while a tiny group of investors seem to build massive generational wealth almost effortlessly? Is it because they're geniuses? Is it because they have insider information? Or is it just pure luck? The truth is actually much more interesting. The difference between a millionaire investor and a broke gambler isn't a secret algorithm. It's a philosophy. It's a mindset found in a book that was written over 70 years ago, yet it remains the ultimate Bible of the financial world. I'm talking about The Intelligent Investor by Benjamin Graham. Warren Buffett, the richest investor in history, said that reading this book changed his life. Today, I'm going to break down this masterpiece for you in a way that's deep, extensive, and easy to understand. By the end of this video, you won't just look at stocks differently, you'll look at money differently. Let's start with the most important distinction Graham ever made. And that's where most people get it wrong, the difference between investing and speculating. Most people you see on social media screaming about the latest crypto coin or the next moon stock are not investors. They are speculators. They are essentially gamblers at a casino, hoping that someone else will pay more for their chip tomorrow than they paid today. Graham says that an investment operation is one which, through thorough analysis, promises safety of principal and an adequate return. If you aren't doing the homework and if you aren't protecting your initial cash, you aren't investing. You're just crossing your fingers. The intelligent investor realizes that a stock isn't just a ticker symbol that wiggles on a screen, it is a piece of a living, breathing business. If you wouldn't buy the whole company, why would you buy a single share? Now, Graham divides us into two groups, and you need to decide which one you are right now. There's the defensive investor and the enterprising investor. The defensive investor doesn't have much time to spend on the market. They want safety, simplicity, and freedom from worry. Their goal isn't to beat the market, it's to grow with it. On the other hand, the enterprising investor is willing to put in the hours, the research, and the sweat equity to find those hidden gems that the market has undervalued. But here's the warning. Most people think they are enterprising investors when they are actually just lazy speculators. If you aren't willing to treat investing like a second job, stay defensive. There is no shame in it, in fact. The defensive path often leads to more wealth because it prevents you from making stupid, emotional mistakes. Speaking of emotions, let's talk about my favorite character in financial history, Mr. Market. Imagine you own a small business, and every day, a man named Mr. Market shows up at your door. He's a bit bipolar. Some days he's incredibly manic and optimistic. He tells you the world is great and offers to buy your business for a huge inflated price. Other days he's deeply depressed. He tells you the economy is collapsing and offers to sell you his shares for pennies. Here is the secret. Mr. Market is your servant, not your master. You don't have to listen to him. If his price is crazy high, you sell to him. If his price is ridiculously low, you buy from him. But most people do the opposite. They get scared when Mr. Market is depressed, and they get greedy when he's manic. The intelligent investor stays calm. They look at the numbers, not the noise. But how do you know when a price is actually low? This brings us to the core pillar of this entire book, the margin of safety. This is the most powerful concept in all of finance. Think of it like this. If you're rebuilding a bridge that is designed to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 30,000 pounds, just in case a massive truck crosses it by mistake. That extra 20,000 pounds is your margin of safety. In the stock market, if you calculate that a company is worth $100 per share, don't buy it at 95, buy it at 70. Why? Because you might be wrong. Your math might be off, or the CEO might make a mistake. By buying at a discount, you protect yourself from the trucks of life. You don't need to be right about the future. You just need to be protected against it. Let's be real for a second. Investing is hard because our brains are wired to fail. When we see red numbers on a screen, our brains react the same way they do to a physical threat like a lion chasing us. We want to run, we want to sell. But the intelligent investor knows that price fluctuations are actually your best friend. A market crash is just a giant clearance sale on the world's greatest companies. If your favorite pair of shoes went on a 50% discount, you'd be happy, right? You'd run to the store. So why do people run away from the stock market when it goes on sale? It's because they lack the discipline that Benjamin Graham preaches. As we wrap this up, remember that being a smart investor has nothing to do with IQ. It has everything to do with character. It's about being patient when everyone else is rushing. It's about being brave when everyone else is terrified. Graham's message is clear. You don't need to predict the future to make money. You just need to follow a system, stay disciplined, and never pay more for something than it is actually worth. If you want to take control of your financial destiny, start by looking at your portfolio through the eyes of Benjamin Graham. Ask yourself, am I investing or am I speculating? Do I have a margin of safety? Is Mr. Market tricking me today? If you found this deep dive helpful and you want more breakdowns of the greatest books ever written, hit that subscribe button and ring the bell. Drop a comment below and let me know. Are you a defensive or an enterprising investor? Let's start the conversation. Thank you for watching, stay disciplined, and I'll see you in the next one.